Silver's recent breakout has caught the attention of everyone in the metals market. For years, retail traders, hedge funds, and institutional players have been circling the $25–26 range, waiting for a decisive move. Overnight, the price surged above $26.20, triggering forced liquidations across major futures desks and creating a ripple effect that spread from New York to London and Hong Kong. It wasn't just a normal technical breakout. Open interest spiked, volume surged, and market chatter confirmed that this was smart money taking positions that could dictate the next major move. The panic among short-term traders contrasts sharply with the calm confidence of larger institutional players, hinting at a major structural shift in the market that only insiders fully understand. This setup isn't happening in isolation. The metals market has been quietly tightening, with COMEX silver inventories stagnating near multi-year lows, while global industrial demand is rising. Supply constraints from major mines in Latin America and Asia are limiting physical deliveries, while futures markets are still highly leveraged. When these conditions collide with a sudden technical breakout, it creates a perfect storm for volatility. Traders caught on the wrong side of this move are being forced to cover positions, which in turn accelerates the move, creating a feedback loop that can define the price trend for weeks, if not months. Everyone holding dollars, industrial contracts, or investment portfolios should pay attention, because this isn't just a silver story. It's a symptom of broader financial stress. Central banks are navigating slower economic growth and sticky inflation, which affects interest rates, real yields, and currency stability. A weaker US dollar amplifies the appeal of hard assets like silver, while rising physical premiums indicate growing shortages in the real market. For investors, this combination can influence portfolios, commodities exposure, and even corporate hedging strategies, meaning a move in silver can ripple through global financial systems. Industrial users of silver, from electronics to solar energy, are also impacted, as supply constraints push premiums higher and raise costs across industries. For consumers and businesses alike, the stakes are real. A sudden jump in silver prices affects manufacturers who rely on industrial silver, driving up production costs for electronics, renewable energy projects, and medical devices. Investors holding paper silver may see temporary gains, but without understanding the physical supply dynamics, they risk being caught in a volatility trap. Smart money, by contrast, is positioning for this divergence between paper and physical markets, showing that understanding the structural story is critical. When financial instruments disconnect from the real economy, losses can accumulate quickly, especially for those who underestimate the size and scope of the move. The impact isn't just theoretical. It translates into higher prices, operational challenges, and shifts in investment behavior. The trigger for the current silver move came from an unusual confluence of events. The May futures contract broke through the $26 level on higher than average volume, forcing short covering that accelerated the price rally. At the same time, COT data revealed hedge funds increasing non-commercial longs, signaling confidence from sophisticated players. Physical premiums in Asia and Europe also began rising, reflecting tighter availability of deliverable silver. This dual pressure, futures positioning and physical scarcity, creates a scenario rarely seen outside major market cycles, where both retail and institutional behavior converge to push prices dramatically in a short window. Underlying this breakout is a core mechanism that reflects both market structure and macroeconomic realities. Futures markets are still highly leveraged, creating the potential for rapid moves when positions unwind. Physical supply is constrained by logistical bottlenecks and slowing mine output, meaning paper markets can no longer fully dictate pricing. Simultaneously, macro factors, slower Fed rate cuts, weakening real yields, and currency fluctuations are incentivizing investors to move into silver as a hedge. When these forces align, the result is an amplified effect on price, showing that structural imbalances, not just sentiment, are driving this market. It's a textbook example of how layered market forces combine to create explosive setups. This isn't just a numbers game. It has real human and business consequences. Companies dependent on silver for electronics, solar panels, and medical devices are suddenly facing rising costs, which can cascade into product pricing and supply chain decisions. Investors who misread the market risk sharp losses as volatility spikes. Even retail consumers can feel the impact indirectly, as higher production costs filter down into finished goods. The divergence between paper and physical markets underscores that without careful risk management, both small and large players can be caught off guard. Smart positioning now can protect against losses, while missteps can have dramatic consequences. The first compounding crisis is financial leverage. Many hedge funds and retail traders remain heavily short, underestimating the structural tightness of silver supply. As these positions unwind, it not only fuels the rally, but also amplifies volatility across futures, ETFs, and derivatives tied to silver. This can trigger margin calls and forced liquidations, creating a self-reinforcing cycle. Meanwhile, industrial users scrambling to secure physical supply exacerbate the imbalance, creating higher premiums and adding another layer of pressure on prices. The interplay of financial leverage and real-world demand can transform a simple breakout into a multi-week or multi-month trend. The second compounding crisis involves macroeconomic and geopolitical factors. Central banks are navigating a delicate balance of controlling inflation while supporting growth. Currency instability and global trade tensions mean that precious metals become a more attractive store of value. Industrial demand continues to rise for high-tech applications, while geopolitical stockpiling increases physical scarcity. These factors create overlapping crises that reinforce each other. Slower Fed action weakens yields, rising industrial demand tightens supply, and currency pressures make metals more appealing. This layered complexity increases the odds that silver could sustain its breakout and challenge historical highs. On a national scale, the implications are significant. Rising silver prices affect everything from industrial production costs to investor sentiment, and even national reserves management. Companies importing silver for manufacturing will see higher operational costs, potentially impacting employment and pricing. Investors recalibrating portfolios influence financial markets broadly. Moreover, central banks and national policymakers monitor commodity inflation as part of broader economic stability measures, meaning that a sustained move in silver can feed into national-level decision-making. The silver market is no longer just a niche investment. It has become a systemic factor in national economic health. The final warning is that markets are entering a structural shift. The divergence between physical supply and paper speculation is reaching levels rarely observed outside of major cycles. If leveraged positions unwind further or industrial demand spikes unexpectedly, volatility could intensify, reshaping market behavior for months. Investors must watch key levels, monitor physical premiums, and understand the underlying macro drivers. The message is clear. The silver market is telling a story of structural imbalance, and only those who pay attention to fundamentals, positioning, and global factors will navigate the next phase successfully. Independent analysis and careful observation are now more important than ever.